Hey guys, what's up? Thanks for watching. Just a heads up, I am still learning in my content journey here. I messed up the microphone settings. I don't know how, I've been wearing this thing and it's not that comfortable, to be honest, but it makes the sound really good. But I messed it up for the other parts of this video. I apologize. Bear with me because it's good content. So hang in there and we'll get it back on track for next time. Thanks, guys.
The wealth manager is going to be leveraging technology to interpret and synthesize sets of complicated data, running it through proprietary models to figure out through backtesting if these strategies have been and can continue to be into the future profitable. And that's what you need to do when you're in complicated times. But speaking of time, every once in a while, like Warren Buffett has done, sometimes it's not a position or a swing trade. It's not a buy and hold even. This is the investment theme of a generation. I'm going to hold this. You're going to pry it from these hands over my dead body. And that's what we want to do today is think about in a market like this, which is choppy, there are bullish cases, there are bearish cases. Do you want to be in equities? Do you want to be in bonds? We got to get deeper than that and think thematically, where do we want to be positioned as we move ahead through 2024, 2025, and beyond? So that's what we're looking at today, investment themes to outperform. Jump around, skip around, find the part that is intriguing to you. By all means, go for it. There'll be timestamps below. And here is our outline, starting with what I believe is at least one of, if not the top core issue of our times. And this is a generational issue, looking at demographics, how it applies to how wealth is concentrated, and what people believe in terms of which side of the political aisle they're on. And what I mean by that is basically not left versus right, but regulation versus deregulation, free and fair market principles versus government oversight. That, I believe, is more important fundamentally in terms of how it is going to impact how you should be putting capital to work. And so from the perspective of private wealth management, I believe it is one of the core issues of our time. Then, of course, we'll look at the private markets, looking at some venture capital stuff, some private equity stuff, some alternatives. We'll look at Bitcoin, of course. Then we'll get into US markets. This was one of the worst weeks we've had in, I believe, since about September 2023. So we've had the seasonal weakness. Maybe that weakness has been front ran, should be uphill from here or downhill, whatever. We'll look at that. Then thematic stuff in the back half of 2024, 2025, and beyond, what themes we're seeing. And then we'll give you our point of view, how we're managing money, what we believe is the best way to do it, and what you should be looking for in the financial services industry, what type of advisory team and wealth management practice you should be looking for. I've said it many times, I'm bullish on family offices. I'm bullish on working low fee, access to early opportunity stuff. You should have a wealth management team that outperforms, not only from an investment perspective, but also is helping out your spouse, your parents, aunts, uncles, children. You should be working with someone who's looking generations in advance. The bare minimum should be that they're able to outperform markets. I'm just going to throw that out. That should be the bare minimum. But they should also be doing that at a low fee, helping with taxes, helping with estate planning, helping you manage your business, and helping you manage your family balance sheet and finances for this generation and beyond. So that's our point of view. But how to actually do that, we're going to talk about at the end of this video. To date performance for all of these different countries, and we're looking at just about all of the major world indices here throughout the Americas, the Africas, Europe, Asia, you name it. And wouldn't you know it, is that Argentina at the top of the list? Yes, it is. Now, why would I bring that up? Well, if you've been following Javier Milei, this very interesting, polarizing figure who is almost like a trumped up version of Elon Musk. Now, when Musk took over Twitter, on day one, he famously fired 75% of the staff. And I know it's a political topic, it's a partisan issue to say whether Twitter has been better or worse. I'm going to tell you, from my perspective, the platform has been absolutely fine. I use the platform. I think it's one of the best free tools in the world. And I don't see how you could argue against that unless you really just dislike the free flow of information. But I don't really want to get into all that. But so why am I comparing Musk to Milei? Well, Milei got into office and gutted, I believe, something like 80 or 90% of the government-sponsored issues. He balanced the budget. within 9 weeks, and they were one of the most unbalanced budgets of all of the countries in the world. And since then, look at how the market has performed. So this is one of these things. When I'm talking about core issues of our times, why would that not be the most popular thing of all time? I mean, my goodness, why wouldn't you celebrate this? This is a great turnaround. It's phenomenal. Why would we not be celebrating this? And it really gets you thinking about people's different incentive structures. Now, let's try and make some more points here. Looking here, this is from the Financial Times, and I'm sure you might want to be quick to dismiss this because it feels such an outlandish comparison to make. But let's look at the increasing purity of cocaine over time while price has stabilized. And this is through a period of zero interest rate policy when every other asset has gotten inflated. So what we're seeing with shrinkflation, or with the quality of goods and services decreasing while the cost is increasing, the quality and the purity of cocaine is increasing and the price is stabilized. How could that possibly be? Well, this is a deregulated market. Cocaine is illegal, therefore the government is not involved in how it gets distributed. So these people that want to make this point about corporate profits and greed being the culprit for high inflation, if that were the case, I mean, don't you think drug dealers would be pretty greedy? They're not following the rules, so wouldn't there be a really high risk premium for them to deliver products to you? Not necessarily. Why? Why is that the case? Because it has no choice but to operate under the dynamics of free and fair markets. Now, granted, it's not necessarily a free and fair market if it's an illegal product, but the principles are there. If you don't deliver the product at a high quality for a fair price, you can't sell. And you're not going to get any PPP loans or any sympathy from the banks or the governments when you're dealing drugs. So, Millet, and again, there's a weird outlandish comparison, but how has Argentina turned it around? They deregulated. What happens when you deregulate? The quality of goods and services go up, the prices go down, your economy starts really chugging along. So why would that not be popular? And this is why this is a core issue of our times. Let me make sure. It's about the efficiency of your message. This is why political voting blocks are so important, and why it helps to have things like unions, or to, put people by their identity preferences or politics, whatever the words and the technical jargon is. But look here. Wealth concentration is a big one, and the wealthiest people have the majority of the assets. So you can play on that by looking here. The bottom 50% have so few assets. So it's such an appealing message if they are low information voters to tell them you're going to get your fair share. The problem, going back to looking at a place like Argentina, is that when the government gets involved, it's bad for the economy, it's bad for the stock market. Looking at the product we just looked at a moment ago, with its purity and the quality of it increasing, and the price flatlining, obviously being better for the end user consumers there, that's what happens in a deregulated, free and fair market. And as the economy performs well, as the stock market performs well, consumer confidence increases, you get the maximum benefit of the goods and services being delivered. People are happy, there are more jobs, and it's a good thing. But from the perspective of just looking here at this chart, obviously it's a compelling point to say, wealth is unequal, I'm going to make it equal. And as a result, you're going to get this increased political polarization, and it's going to be very challenging for asset prices to continue to inflate unless the government is involved. So this is a core issue of our times, and this is why I'm so bullish on low-fee active management with access to alternative investments, because this is just not going to be the same market it was. There's going to be a lot of topsy-turvy, volatility, unwinding, plenty of issues, and it's going to be hard to create and extract real wealth and real value if you're not actively managing and positioning correctly, because this core issue is just not going to go away. Of bottoming for the private equity market. I won't go into a ton of detail here. You could click back through my capital markets update and our Q3 outlook. We'll put the video links below because not a lot has changed in the past few weeks. We tend to think that the easing liquidity conditions are going to create good circumstances for activity to pick up. We think the sizes of the deals are going to pick up as well. So boom to bust to meh, I don't know. I mean, it's the Wall Street Journal. You can't really expect the most accurate reporting from the mainstream financial media, but we are seeing deal sizes and deal activity pick up, and that's in mergers and acquisitions, investment banking, private equity backed exits, and the like. So check out our videos below for that one. This is always important from the perspective of wealth management, looking quarter to date here, and these are the performance factors. So what we mean by that is not a straight performance quarter to date. We mean relative to the S&P ETF. So this is the SPY. Now, spin-offs have done the best. So this is merger acquisition type activity, buybacks. So this is, just companies that are well capitalized and in position to be buying back shares. You could just sprinkle capital and just say, I want to own the companies that are buying back stock. And you can do that. But here's an important one. Private equity is outperforming and hedge funds are outperforming. So private equity by a little more than 3%. Hedge funds by a little more than 2.5% in this is July, August, and the first week here of September. So important because we always talk about rebalancing opportunities, and this is why, as markets, they go through their tumultuous times, this is when it makes sense. It doesn't always make sense to have a full allocation to the alternative space, but it does have a benefit to have a sleeve and to rebalance when the time comes to do so. Meanwhile, you got to be careful. I always tell people about keep in mind who the messenger is. This is from Tavi Costa, who I like, by the way, great guy. And Crest Capital, they do a phenomenal job. So I don't want to criticize him or say this is right or wrong, but the old chart, the new paradigm followed by denial, followed by return to normal, followed by complacency, followed by the return to the mean, and then you end up with a brutal sell-off. He thinks that the venture capital chart tends to look like that. And you know what? It kind of does. You'll get fear, then you'll get capitulation, then you'll get despair. So he thinks we might not be there yet. I don't know. I mean, it's a complicated time ever since COVID. And then the interest rates came up. 2022 was a tough year. Access to capital has been challenging for the past couple of years. I don't think that this is what's going to happen. I could see the case for it. I could make a case for it. I could make a case against it. But at the end of the day, if you work with studs who know how to manage money and know how to put capital to work effectively, then you're never going to be buying into junk. All right, so I would say what could be dying is the spray and pray mentality of venture capital, where it's like, let's put $25,000 into 50 different things. 24 of them are going to go bust, but one's going to be worth $1 billion one day. I don't think we're going to be producing that many unicorns in the crony capitalist state of affairs we have now. So maybe it makes more sense to do more secondary type funds or fund to fund type activity in the private world instead of venture capital. But, hey, we're in America. I'm wearing a cowboy hat. You saw me at the beginning of this video. Obviously, I still think there's going to be good venture capital opportunities out there. So, it's just something to think about. Now, in terms of Bitcoin, got to talk about Bitcoin because people are so, the sentiment, I mean, we're still up phenomenally well this year in Bitcoin. So, you got to zoom out. It's still just a giant bull flag. I'm looking at the long investor. He's a great, I'm not sure what he would classify himself as. He's an investor is what he is. He's long only. He position trades and he buys and holds. He's good at what he does. He uses a lot of Fibonacci's, chart structuring, Gauss theory, Elliott wave. And if you look here, I mean, we've held this 382 Fibonacci around 51,300. Looks like we're probably going to come back down there and touch it again. We could slip down below and hit the 0.5. And it wouldn't be the craziest thing if we even got to the 618. Pulling back to the 618 in your Elliott wave theory during a bull run is pretty normal. And then if we bounce, so what you want to see, you want to hold. Let's see if we can hold this 51. Obviously very bullish. We can hold this 45. Not quite as bullish, but still bullish. Then we start making a new high or start making higher highs. We breach above here, and our targets are 84,000 or so, or we could get to this $100,000 level. It's not out of the realm of possibility by any means. And to give you some insight into seasonality, September generally not a great month, but October we smash it more often than not. November we do pretty decently. I mean, look at these averages. So average, let's just sit there, around -5% for September, so that tracks. Plus 23% October, plus 47% November, plus 5.5 in December, plus 3.25 January, plus 15, then plus 13, then plus 13, then plus 8. So if you can stomach it this month of September, times look good ahead for Bitcoin. And we could get into our bullish case for Bitcoin. We've done it. I'm not going to do it here, but I think if you can stomach it right here and now, just know September is usually a weak month, followed by about 6, 7, or 8 months of positivity. All right, so take that for what it is. Moving into the public market section here, obviously, structurally speaking, that looks a lot like a double top. We're going to want to wait and see how this plays out. I mean, you could have made a case for it that this was a little bit like a double top here, and it was, or if you wanted to zoom out and say like here, and then it went down. And those have played out, but depending on your time frame, we ultimately kept going higher. So you got to really think about what you're looking to accomplish here. It doesn't make sense to hedge right here and now. You know, maybe it does, depending on your own proprietary models. But if you didn't do anything, let's say you're pretty passive and now you're thinking, okay, now it makes time to take risk off. Just work with a professional to figure out how to mathematically optimize the way you're going to do that, because we could hold here. We could keep going sideways. So if you're buying puts here and you just get chopped up going sideways, you're not really protecting much from the standpoint that the puts are going to expire worthless and we're going sideways anyway. So you got to pull back in time. So I don't know. I could talk about this for a long time. I just would say you got to take a breather here if you're not actively hedged right here and now. And part of my thinking is, here's Jake, I don't know how to say his last name, but he's a good follow over on Twitter. He's just doing a quick one here to say, positive divergence is not there yet. The oversold RSI, we're not quite there yet. The MACD is crossing down. So we're not really seeing the technical indicators that we're about to start curling up. So you would think that we're going to see that relatively soon here. You'll start seeing the curling, you'll start seeing this flattening out, but it hasn't happened yet. So it looks like more downside according to him. But then another guy, Banana, I don't know what his deal is. He's a little bit of a polarizing character, but does a phenomenal job. And he's saying every time in recent history that the RSI has been at this level of negative, it has marked near-term bottoms and stopped short of the 200 daily moving average. So he has data to suggest, whatever about your indicators, mine are saying that we're going to start curling up here. And I tend to think when you have really compelling bullish arguments and really compelling bearish arguments, you're just most likely going to go sideways. So, take it for what it is from that perspective. Then here's an analyst, Torsten, over at Apollo. He's got his 10 data points as to how and why we have achieved the soft landing, looking at unemployment, wage growth, the transactions for the consumer, retail sales going up, jobless claims flatlining, continuing claims flatlining, default rates trending down, so on and so forth. So, this is another one where usually when the analysts all get into one camp and start thinking something, it tends to be the opposite that happens. So another one where, you could make either conclusion looking at that. And here's a good example. Here's from Zero Hedge. This is the Fed funds, the number of rate cuts priced in for the September FOMC meeting coming up. And I mean, look at it. It was going from around 1.25 up to 2, back down. And this is all in like a couple of hours. So in terms of the market efficiency, trying to price in where things are headed, like obviously Zero Hedge likes to take the piss. Well, actually. But yeah, I mean, this just gives you a sense that even the most sophisticated mathematical models from the wealthiest Wall Streeters that there are, even those models are having a hard time pricing in what's going to come next. So chances are we probably need to go sideways for a little bit until there is a clear direction. So this is the right time to take a step back and think more thematically in terms of trying to make big moves, in my opinion. Rainy, so I don't want to spend a lot of time here, but this is from Merrill Lynch, the investment clock. You could make a case that a lot of people are in the T-bill and chill short-term treasuries, start to see utilities, healthcare staples in the defensive sector start to perform, and the gold miners are starting to catch a bid. Quality assets starting to do well. TLT to long-term treasury is starting to tick up. So a decent case that we're in the slowdown period. But we haven't seen the large cap tech growth really roll over to where we get this good entry point when we hit the recession. So hard to say where we are, but we are seeing some interesting stuff where you see some late cycle sectors starting to do well. But commodities certainly have been killed. Small caps have underperformed substantially. They're starting to catch a bid. So a weird one where we're sort of stuck between a variety of different stages, so to speak. I'm seeing this one pop up a lot now that the dollar should be coming down. It's around 100, 101, 102. We should see it settle into like the 92, 95 range when the rate cuts start to occur. Will that bring back this bottoming inflation and this 1970s style reinflation? Well, it's going to be a function of economic growth. Because if we roll over and GDP starts to weaken, we're just not going to have the spending power to be buying as many goods and services to push the price up. Unless we get into a stagflationary environment like the 70s, I'm not sold that that's going to happen. But you know what they say, history doesn't repeat, but it often rhymes. Well, that analog is damn accurate. I mean, something to keep in mind. And keep hearing about this commodities super cycle, this secular bull market. If it is just getting started, then the good news, well, the bad news is that would be troublesome from a market perspective, especially the way everyone is positioned and the amount of people that need to retire. That I don't know what the status of their 401ks money management looks like, but I would assume they're just pretty much going to be flowing into these index funds, and I don't think that they're really positioned for this type of market. But okay, so that's the bad news. The good news is, if you wanted to reposition, I mean, you have a lot of time. Like, these things play out over years. Like the 10-year annualized returns that we're looking at, if you get this inflationary spike, this is like from 1965 to like 1982, 81, that you had this run. So there's time to get ahead of it. And meanwhile, I do this from time to time, so I'm guilty of it, but sometimes I just don't separate gold from the other basket of precious metals. And I think about gold and the metals being commodities, but in reality, you can see gold being number one in 2020 when commodities was down at the bottom of the asset class annual returns. And then the opposite, gold at the bottom, commodities at the top. And then in 2024, getting a repeat of 2020, gold at the top, commodities at the bottom. So just to be clear, you don't necessarily want to have allocation to commodities the same way as gold. It's one where, well, at least, carve out two different sleeves in terms of your exposure to the hard commodities and the hard assets, because you got to just understand that they perform differently. The recession probabilities, generally recessions catch people by surprise. That's kind of why they're so devastating. And we could get into that, but I'm not going to do that here. So this sounds a little bit counterintuitive, but as this ticks higher, you get more response mechanisms. More people start working around the clock to flood the system with capital and to do the things that need to get done to keep things propped up, especially if the swamp, the quote-unquote swamp, is really anti-Trump. Then they're going to be doing everything they can to keep things together for the next few months so that it doesn't make Trump's odds higher of getting back into the White House. Because, if we roll over here, it's just going to make it even easier for Trump to get back in. So I tend to think that you need to be more scared if this is like at 8% instead of 38%. But hey, that's just take it from me. Okay, and now as we start to switch more into thematic stuff, everyone talks about the United States being the biggest, the baddest, and the best, and it is, let's not get that twisted. But Asia showing up on these big top 10 GDP producers. China, obviously a big player, and they say the US exports inflation and China exports deflation. Well, I mean, they've got all these ships, they do all their production, and they can just load up the stuff and send it out to the world. And that's how they're making so much money. And Tokyo's up there. So, hey, this is just something to think about. London and Paris, by the way, showing up. And we'll probably start to see some Middle East, like Saudi Arabia, Dubai, that area start to do some stuff. If Brazil could clean up its act a little bit, they could be on here at some point. It's a big world. It's a big world out there. That's a theme. as tax rates go up, just to keep in mind, capital mobility. I manage money for some people who have moved. I manage money for some foreigners, and there's always a conversation about tax to make sure you don't only focus on the return, but how to shield it from tax and then look side by side at which strategy ultimately makes more money. So don't be too afraid. It's a big global world. It's pretty safe. It's pretty spectacular out there. There's always going to be a way to do well. And hey, I mean, all the more reason to set aside our differences and get along with Asia, huh? I mean, there's a lot of money out there. Why can't we play nice?
Okay, so this point of view that we have is that let's just get right to it. Financial services industry is dead. Wealth management, dead. Investment banking, dead. And our evidence for that is the increasing market share that family offices are getting. And good. They're low fee. They give you access to asset classes that outperform. They cut out the middlemen. They're not giving you this, well, we're gonna be safe and giving you this compliance themed message and overcomplicating stuff. And it's all wacky out there. So this is a good thing. You can also see it. You see companies like Robinhood getting more assets under custody than the big guys like Fidelity and Schwab. Not more in totality, but capturing more and more market share. It's happening, but it is a very slow process. So in terms of thematically, what we're seeing is you should, at a bare minimum, get your wealth management strategy. It should be, if it's not a family office, then at the very least, they should be looking at your investments, your family's investments, generational wealth. So that's the accounting practices, the estate planning, everything else that goes into it in terms of managing for your values and lifestyle and donations, all of that stuff. And they should be looking generations in advance. Okay. Um, and at the very least, bare minimum, they should be outperforming. I mean, what are you paying them for if they're not outperforming? Okay, and that's just on the money and the personal, the family side. Now, you should also have an entrepreneurial streak. Well, maybe not that you should, but if you do, if you're a business owner or if you're entrepreneurial or you're into venture capital in any way, shape, or form, even if just on the buy side or on the sell side, and you're not the owner, operator, founder yourself, they should be advising you on those items as well as managing your finances and doing all that family office stuff and providing all that support. So we have a point of view that you need something like 8 to 12 different investment classes. You need to have good proprietary models that are part of a back-tested strategy that clearly does outperform, that they're doing this for you, and that the AUM fees that you're paying them are used as a credit against the tax planning and preparation and strategy sessions they're doing for you. So you're not paying a direct fee for service there. Same with the estate planning. All right. So, I'm always biased and I'm skewing towards the family office message, but I think, okay, let's recap it. They should be outperforming 8 to 12 different investment classes, including the democratization of access to good risk adjusted alternative assets, private equity, venture capital, whatever it is. Um, Good proprietary models for rebalancing while pairing that with a good tax loss harvesting strategy so that you can always mitigate taxes. And okay, the list could go on, but the core message here is we're focused on the upside, and we think there are substantial risks out there macroeconomically, inflationary, socio-political, you name it. There's every type of risk. We've lived through it. The exogenous events like COVID, the wars that are out there, and then even just the systemic stuff like 2022 when stocks and bonds both sold off dramatically. Substantial amount of risk out there. We are not risk averse. We are risk prepared. And we want people to understand that at a minimum, they should feel a position of relative strength. They should feel freedom. They should feel security. And they should not be paying a premium for average performance that doesn't provide all of the other access to the privates, the alternatives, as well as these other services that they have to pay on top of and then pay more and more and more. And you just end up broccolied out into more fees and getting overcharged. So know that as a consumer, there are other options out there. And, a company like us, we're here. We do complementary analyses for all sorts of different people because we like to help, we like to add value. And I just want people that are watching this, even if we don't end up working together, this message applies to anyone. You expect more. And I know there's such a temptation to stay in the relationship because someone, he's been to your son's little league games and he sends you a bottle of wine at Christmas every year. But, have a frank, honest conversation that you're looking for more and there are services out there that are offering you more and they better be prepared to meet that at the very least. Otherwise, you got to make a challenging decision, but ultimately do what's best for you. And this has been a video about putting capital to work and about investments, but sometimes you got to think a little bit counterintuitive. It's not the specific, private credit and equities that we're investing into, but it's the choices we're making that are big investments that we're making too. So think about that. And if it does make sense to have a conversation and, do some prospecting about other services that are out there, and if they're a good fit, hey, by all means, I'd love to chat to you. All right. Thanks for watching, guys. We'll see you again next time, and I'll try and get my content game up to speed because I feel like I got some good stuff to say. I just don't I'm not a content creator, so I gotta still figure out like my video and audio and how to do this whole thing. But thank you guys for watching, and until next time, have a good one.